was really lucky with the family that I was raised with. My parents, they were born in India, they immigrated here, and so I learned everything I know from my dad. You're not going to get something for nothing. There is always a trade-off to be had, and it's not anyone else's job to decide that except for the investor. Everybody's posting the yield number. Nobody's sharing one level down. Capital growth plus yield equals total returns. Looking at the history of those three variables is really the best way to assess what's the right fit for you. It's not win or lose anymore. It's win or learn. And when you learn, all of a sudden you snap into this growth mindset. Biggest thing is if you can get to a point where you earn enough little money soldiers to then go and that little army can go work for you. That was also a big learning, like save, to get a little nest egg. And then all of a sudden it'll start to create value on the feeling of just financial relief. And being able to now in February of 23, be totally present for my daughter's birth. And then it also gave me the time to stay focused, stay disciplined, and stick to the plan. Don't get greedy and everything will work out.
Investors, welcome back to another go-round of Masters of the Market. Now, this week, I am incredibly excited to welcome to Masters of the Market, Katara, the founder and CEO of TappAlpha, here to talk all things dividend, income investing, and a covered call strategy that you cannot go wrong with. So, I want to welcome you to Masters of the Market, and I want to toss the first question right over to you. What is the Katara story, and how did you get to where you are today?
Ari, thank you so much. It's great to be with you. Super excited to have this conversation. Actually, I came from a totally different world. I came with an engineering background. And so starting back in school, studied computer engineering, ended up going to work for a startup in Silicon Valley in my early 20s. And it was a small company. I was doing hardcore embedded system software engineering. That was amazing. And I loved the startup environment, just, sleeping under the desk and cranking and working hard. And then our company got bought by a big company called Cisco Systems. And Cisco is a great organization, but it's a corporation. And for me, the excitement of the startup environment really is kind of what got me fired up. And so I was lucky enough to be able to take a little break from the corporate world and ended up starting my very first tech company back in 2005. And the whole idea there was construction technology. You bring a mobile technology to construction, which is sort of a late adopter. And I built and ran that company for 17 years. But the common through line for me has always been, how do you take innovation and apply it to solve real world business problems? And I've always been super passionate about finance. And so fast forward now to October of 22, and I look back and half of my career was behind me. And I was sort of in this moment of like, if I'm going to do anything different with my life, I've got to make a shift and I've got to do it soon. And the other thing that was really the driving factor too is my wife and I were pregnant at the time. So 4 months from that date, we were going to have our first baby girl. And so all of these things were coming together. And I was like, I got to make a shift, let's take a risk and see what happens. But the hard part was, how do I make ends meet every day? And so I don't know if you remember in October of 22, but the markets were way down. And because I was busy with my day job, I had always sort of been just a long-term buy and hold investor, bought the SPY, broad market index, did great for us over time, and I didn't have to worry about it. But I didn't want to have to liquidate shares in order to sort of make ends meet. And I remembered a strategy that my dad had taught me about selling covered calls on top of your existing equities, and you have the potential to keep your shares, but then you can generate some income on top. And there was this perfect storm because right in October of 22 was when daily covered calls became available on the S&P 500 index. And I thought, all right, let me try this. So I tried it for a few months and it blew my mind. Lo and behold, fast forward 2 months, and I was able to cover the lion's share of our mortgage just with the additive income from selling daily covered calls on top of my SPY shares. So I got to keep the SPY shares and then generate income for the family. And that was sort of my aha moment, where the feeling of just financial relief and being able to now in February of 23, be totally present for my daughter's birth and for her first year. And then it also gave me the time to sort of focus on building the next business. And the next business ended up turning into trying to bring this value to market. I just was thinking like, this has brought so much financial relief and capability to our family. How do I share it with other families like ours? And so the drawback was, obviously when you're doing this stuff every day, there's a lot of math that I do to figure out the positions. And it just takes a lot of time every day. It's like 3 to 4 hours a day. And if I was working, there's no way I could have implemented the strategy. So with the software background, I ended up writing myself a cloud-based technology that helped take 4 hours of work down to under 5 minutes. And that was, I think, another moment where I said, look, if I can package this in some way to add value to the market, let's figure out a way to do it. And so we were deciding which way to go. Market and sell a fintech product where people log in to a software service, connect their brokerage accounts, or then I got connected with some folks in the ETF issuing industry. And I never thought it was within reach to actually issue my own ETF, but I got connected with the right people and they're like, we can help you get this out to market. And so we ended up pivoting and deciding to take this value, wrapping it in the efficiency and convenience of an ETF. And we just launched our very first publicly traded ETF called TSPY on the NASDAQ about 3 weeks ago. So that's sort of what brought us here today. And it's been an incredible journey to sort of get here. But the biggest thing that's so fun to watch is just to see how others can benefit from this strategy without having to lift a finger, and to get that convenience to sort of just get it directly into your brokerage account without having to do too much heavy lifting. It's really been amazing to sort of see this take hold.
I gotta ask, it seems like you were investing long before TappAlpha and the release now of TSPY, and we're gonna get into all of that. So where did all the passion come from to even start investing? I mean, you had a job in engineering. It seems like you were already a bit of a risk taker, to tap into the market and then let alone now building what you're building.
I was really lucky with the family that I was sort of raised with. My parents, they were born in India. They immigrated here. And my dad actually he was an engineer also, but he transferred into financial consulting. And so I learned everything I know about public markets, especially the option side of it, from my dad. But it was interesting when I started, we, as engineers, we take steps, we get bit, and then we adjust. So originally I ended up buying options and sort of trying to participate in the upside. And more times than not, I would lose on those positions. But then my dad was like, let's flip it and let's actually sell options instead. You can set your risk profile, and then more often than not, you'll actually win. And started looking at that, where that was way more in line with sort of my risk profile from an investing standpoint, sort of moderate risk, something that's a little more predictable without actually rolling the dice too hard. You kind of play the house versus the gambler. And that switched a light switch in my mind. And then the other piece too that I really learned, and this is, the mission and vision for TappAlpha, the company, is access. How do you provide access to powerful financial tools to every investor and every advisor? And in the long term, I also want to connect the TappAlpha Foundation, which is, the mission is going to be financial education for all. And that's one of the things that I was lucky enough to have growing up, was a really amazing financial education. But if I didn't have the family I had, I never would have learned about it. And so how do we create resources for people to learn the power of financial tools to help their lives? Then this idea comes of like, you decouple the idea of trading hours for income. And all of a sudden, now you can create the money you have to do the work for you. And so you get that initial snowball, you put it in a place that meets your risk profile, and then you let it do the work for you. And all of a sudden, over years and compounding, you learn that you can reach these moments of financial freedom and financial relief because you've actually had something else doing the heavy lifting versus just the time that you spend.
I'd love to know a little bit more of some of the financial lessons that you were given along your journey from perhaps your father, or just being in your family. As you shared, lucky to be in your position. I was actually just creating a video earlier today, and I was talking about, like, not all of us are born into these, well-to-do families. And perhaps it's not even the well-to-do family, but in a family that's going to guide you or push you in directions financially suitable for you down the line. What were some of the biggest takeaway lessons that you were gifted with?
I think one of the early ones was diversification is important. I sort of early in my investing journey sort of put larger placements into individual stocks. And there's so much concentrated risk when you do that. And so when ETFs actually became available, the convenience of being able to invest in 505 companies with one ETF share was very attractive. And then the liquidity around that too. And so I learned about risk comfort, and it really varies on who you are and sort of what the right fit is for you. And so just being really honest with yourself to say, look, if I earn this much, but I risk losing this much, is that really a fit for me? And then you can dial it into the things that actually fit your comfort zone, because those sleepless nights are not worth it. But if you diversify, and the biggest thing is if you can get to a point where you earn enough little money soldiers to then go and that little army can go work for you. That was also a big learning, like save, save, save to get a little nest egg. And then all of a sudden it'll start to create value on top. But you got to get to that sort of critical mass before it can actually do some real work for you. So those are two really powerful early lessons that I learned. And it was really because of the family that, that raised me in a way that gave me access to the information that I was lucky enough to have. And that's something I want to make sure that we can share with others that maybe don't have the same environment or background to sort of ultimately couple the education with the time, the years that you have ahead of you. It is exponential. The earlier you start, the earlier you learn, and the impact that you can make.
The big question for us now is, where do we start? Because a lot of investors want to go, 100% into these growth stock opportunities, or some of us got trapped by the meme stocks, right? Then there's more risk adverse investors who went towards dividends or ETFs. Where would you recommend that an investor starts?
I think it's really connected to the risk profile. So what's nice about starting when you're young is you have time. And time is the most valuable resource when it comes to thinking about investing. At the beginnings, when you're looking at what's my time horizon, well, I have 30 or 40 years ahead of me to invest before I maybe need to draw on this. You've got a lot more flexibility with respect to where you can put your dollars. But the shorter the time frame, the more you've got to really think about it. And the other thing that is really food for thought is based on risk profile. It's aim big, lose big, aim small, miss small. And one of the things that, the strategies that we're bringing to market, it's more of the slow and steady wins the race. How do you just take incremental harvesting of income and use that? But if you do it on a daily basis, all of a sudden you look back and it actually amounts to something pretty significant. And that, I think, is not necessarily like the big flash in the pan, like, 3,000% growth meme stocks, but it is a way to consistently reach growth goals. And when you multiply that with a time horizon, it's really powerful when you put those two things together, how that can impact your life.
Would you say it's the same for an avatar, let's say in their mid 30s to 40s, or perhaps even closer to retirement?
Changes in the sense of the timeline that you have, because you can take more risk earlier on. But if you need the capital, the hard part is, stock picking and trying to predict the markets is not something I can do. People may be a lot smarter than me, and it's very difficult to do. And so I don't try. And that's why I buy the index funds and just let the markets do what they're going to do. But all of a sudden, like if you have a long-term buy and holds mentality, those daily dips, they don't hurt anymore, because over time you sort of see what they're going to do. And it's really about time in the market, not timing the market. And that, I think, has been a good lesson that's really served our family well over the years. But if you need the dollars soon because of the unpredictability of the markets, you've got to consider putting them in something that's maybe more accessible versus, something that might have a little more risk. And it really is tied to that timeline, which I think is one of the most important factors.
TappAlpha. I want to get into a little bit more of TappAlpha and what's offered here, because what I found to be interesting is, it's the safest bet ever, right? Just invest into the S&P. And I feel like, from Warren Buffett to notorious investors who are out there, that's what the golden rule, right? If you don't know what to invest in, invest into the S&P. Now you've taken the S&P and you've added a strategy to this, covered call strategy. What exactly is the TappAlpha outlook on the S&P and how to strategize with it to maximize income?
The easiest way to think about it is TSPY is the fund, and think about it as tapping the income potential of the SPY. And really, dollar for dollar, if you buy a share of TSPY, you also own effectively the same relative shares of SPY. So you actually own the underlying equity. But then the strategy goes, and it does kind of the heavy lifting of writing that daily covered call that's out of the money to basically go and harvest, small amounts of option premiums every day. And the idea behind TAP was always, tap the potential of what you already have. I had SPY shares, but I wasn't actually getting the most out of the shares that I had. And when I needed it, I was able to tap into it to actually generate this extra income. And that's exactly the value that TSPY is looking to bring to market. where people that are index investors that love the SPY, but also want some supplementary potential income, this does it, but it takes all the challenge out of it because you don't actually have to execute the strategy daily yourself. The fund will do it for you. And then on our monthly distribution schedule, we just sort of deposit the additional option premiums that were collected that month into your brokerage account. And so that was sort of the genesis of TappAlpha as a company, is tap the potential of what you already have. So that's the first fund. The other thing is we have an underlying fintech that helps us do this. And so we'll be able to scale more funds in the future, TDAC for the Qs, TRUS for the Russell, and then long term would love to take this technology and productize it both for advisors and for direct investors potentially, so that whatever equities they have in their portfolio, they can tap into that potential value by running the software platform on top of it to harvest option premiums on top.
Why go with TappAlpha when we can go to some of these bigger dogs like Schwab or Vanguard?
So I think the main differentiator is TSPY is a balanced fund. So there's yield funds that are really just trying to crank out as much of the yield as you can, but there's a trade-off because when you're just focused on yield, a lot of times what you sacrifice is the underlying capital growth. But in this case, TSPY is actually trying to give investors access to a really balanced version of both. We're writing calls that are far enough out of the money. You get a ton of headroom. So we're trying to capture most of the capital growth and upside of the SPY. To Warren Buffett's point, right? If you buy and hold and let it run, it's going to outperform a lot of the funds that are out there. But in addition, we're adding this income generation engine on top to provide some of the income side of it. So I think one of the key differentiators is TSPY is very balanced in both, and we're looking to deliver a balanced outcome for both sides. It's one of those interesting things where some of the yield funds, the income funds are really talking about yield. That's the only number that matters. But if you take a step back and you look at the big picture, total returns are less because the yields are so high. And so the other thing I think that's really important from an education perspective is just sharing that capital growth plus income yield equals total returns. And so we'll talk a lot about total returns as the right metric because it's more encompassing versus being one-dimensional in what the metric is that people are tracking. So I think that's one of the key differences between TSPY and the others. And then the other component too is since we're doing it daily, there's a lot of advantages there. It's highly dynamic, right? The fintech actually helps us pick a position every day. So you have flexibility. If the market's up, you actually can set your position after the market goes up versus being on the flip side of having the market go up and go against you. So that flexibility is really important. The other thing that's really important too is overnight risk. When do earnings come out? After market close. When do market reports and economics reports come out? Before market open. And so rather than guessing beforehand and taking a position, we're just doing it truly same day. So we write it in the morning and it expires the same day. So we try to really avoid any of those overnight risk components. And so that helps us keep and manage the portfolio within the risk profile. And then the third thing that I was really surprised by is the premium advantage that you have in participating in daily options. So for example, if you took a 30-day covered call strategy, there's some big ones out there from some of the big wirehouses, and took the same level of risk, you would get X for your monthly premium. But if you took the same level of risk and actually wrote the daily covered calls, the additive premium over that same period of time I'm collecting the data on this, it's more than 4 times the amount of premiums. And so from a risk adjusted reward standpoint, I'm taking the same risk. Why don't I get paid 4 times as much to take that same level of risk? And that's what you get when you implement sort of a daily covered call strategy, which makes it really powerful. And to your point about fees, this totally eclipses the commissions, which you've got to worry about, especially if you're doing this with equity options. We're doing it with index options. And what's nice about those is they're 10 times as big. So that means commissions are 1/10 the cost because you have to only buy 1/10 the amount of contracts. And so for us, from a fee perspective, we're priced below, I think, a lot of the other competing actively traded funds. One of the reasons we can do that is because of the underlying fintech. But our goal is look, if we can add 7% on top for yield, and we're charging 68 bips, you give $1 to the fund and they give you $10 back. I think that's a order of magnitude from a cost benefit perspective that people can get behind. And so that's how we sort of strategically priced and are wanting to sort of provide value to the market.
Now, some of these funds that are out there, and again, I'll throw SCHD under the bus, it shares with investors who actually read the overview that this is more like a complementary ETF. And I'm curious to know, from your standpoint, should investors solely be pouring their money into whether it's TSPY or other funds, just one individual ETF, or should we go back to that diversification point that you brought up earlier and actually have a TSPY complement our portfolios?
I think it really depends on the investor and looking at the certain portfolio allocation. If there is a big US equities component in a portfolio, you buy the SPY, you buy the VU, this can actually come in that slice of a portfolio. But whatever your diversification is otherwise, there's no reason to necessarily change it. The other thing that actually provides a little bit of a benefit too is it can help sort of take some of the income requirement and feed that need as well. So one big topic of conversation these days is everyone's like, all right, FOMC meeting's coming up. J-PAL's probably going to lower the interest rates. Now the question is how much? Quarter point, half a point. Well, the corresponding income investors that have income tied to the rate, it's going to start coming down. So how do you supplement or replace some of that lost income? And strategy like TSPY that don't have a connection to interest rates, but rather volatility, can be really helpful to supplement the income piece, as long as the fund that you're looking at meets your risk profile. And again, we're low to moderate risk, so we ride it pretty far out of the money. But there are some other funds that are way more risk heavy, or maybe even bearish, where they're writing it close to the money. You can get bigger premiums, but you cap some of the upside. So, whatever the broad-based portfolio allocations are, two spots that it could fill: the big equity piece, and then also to supplement some of the income component. And some, on the advisor side, because it uses sort of non-traditional derivatives to provide the value, some could even put it in the small sliver that could be alternatives. So kind of, we call it the triple threat because it could fill a portfolio need in each of those buckets.
I'd love to ask you about process and fundamentals. What are some of the things that you look at, especially from where you sit and how you see the market when it comes to actually building out a portfolio? I guess the first question I want to ask you here is, what's an ideal number of positions to build on top of a TSPY?
Yeah, that's an interesting one. So, TSPY is something to think about as diversified. You own all of the companies within the S&P 500. So you're diversified in this asset class. And so that kind of checks the part of the spectrum. But other folks like to do a bit of real estate, and there's REITs, and others like to do some fixed income. And everyone talks about 60/40 being dead. And the other really big factor is, again, timeline. So what that spread looks like really depends on the individual investor and sort of where they are in their life timeline and their plan. But for me and our family, I can share that, TSPY is all of our public equity sort of ownership is in TSPY, because we get that same exposure that we had with SPY, and then it's helping supplement the income piece. So it took that whole slice for us. But again, my risk profile is maybe different than many of the other investors, but that was a really comfortable place for us, because to Warren Buffett's point, I get that security, I get that diversification, but I also get some income generated on top. And the thing that actually, was really a good learning when we were bringing this to market, it was hard to get it to market just because the custodians and the infrastructure to get it done, it's a very fast strategy, and it's new. And so they're like, well, we've never done this before. And you actually want to own the SPY shares? And some will be like, it's easier to do it with synthetics or swaps. I'm like, it's important to us as just regular investors in this age category and this risk profile to actually own the real thing. So we really worked hard to own the real thing and then write the cover calls on top. But in doing so, we got a couple of advantages that I didn't even realize. And I got to put the disclaimer in, right? Like, I'm not an accountant, but I'll provide some questions to ask to your accountants about the tax treatment of this stuff. So there's two pieces of value for a covered call strategy. The first piece is the options income, and the second piece is the capital growth of the underlying equities. Well, the options income, we transitioned to using SPX, which is an index option. Those are really great because they're potentially 60/40 tax treatment, 60% long-term, 40% short-term. And they're 10 times the notional, so our commissions went way down. So we're kind of trading a little bit like an institution on behalf of investors. But the second piece, when I was doing this in my personal brokerage account, there's this thing, and again, talk to your accountants, but it's called a straddle rule. So when you take a position that's hedged on underlying shares, it pauses the clock potentially on long-term capital gain consideration for the underlying shares. So even if you held those shares for more than 12 months, but you're doing this every day, if you liquidated the underlying shares to get the capital gain, it would be considered short-term capital gain. But within the structure of an ETF, this is where it gets kind of magic. ETFs are one of the rare vehicles that have this thing called in-kind redeems. And so when the fund, if we're able to sort of not sell those shares over the period of time that an investor owns TSPY, which is how we want to manage it, when the investor, let's say 18 months down the road, decides to sell this share of TSPY, we never liquidate the shares of SPY. We hand those shares in kind back to the bank. And the underlying short-term tax consideration goes away for the end investor, and all the end investor has to pay on the underlying capital growth is deferred long-term capital gains potentially. So these are good questions to ask your accountant, but because we fought to, actually implement this with real shares, we were able to now get this additional benefit potentially to help investors. And for us, like I'm going to be able to participate in this benefit for our family because we're doing it within the confines of the ETF. So there are all of these really powerful benefits in going through the process that we went through to get it to market.
Sure. While on the topic of even talking taxes, capital gains, everyone's getting hit by them. First of all, for anyone who's listening, I think there's a notion that it's like if you're dividend investing, you somehow avoid taxes on income. That's not the case. But what I want to ask you, Sai, is when it comes to investing into dividend stocks, and I had someone else on the other week who just crushed it. I mean, this TSPY would be like a fun for him, and I'm actually going to share it with them, after this chat. But passive income investing these days, I mean, it's a big topic, and it almost makes me feel with all the covered call ETFs that are out there that traditional dividend investing is dead. Am I kind of spot on that, or is it very much alive? But this is just again a complementary fund that we can add on to it, because in today's day and age, I mean, just given all the investment vehicles that have come to the table for all of us to take advantage of, it really does seem like picking individual stocks is like of the old world.
This is an amazing time to be an investor because there are so many great products out there on the market, leveraging and taking advantage of these really powerful financial capabilities that were never available to everyday investors before. And that's sort of the whole goal, is how do you provide that access? So to your point, I think there's still a place maybe in the portfolio for dividend investors, but to your point, one of the reasons we wanted to buy the underlying shares is because when SPY gets a dividend, TSPY is going to pay that right out to investors. So, you get a little bit of the best of both worlds if you end up picking the right investment vehicles, because those dividends will be there. But stock picking for me has never been part of my strategy. Broad-based investing has, where you're actually rising tide lifts all boats when the markets are up and down, and you don't have individual equity risk. Value stock picking is very difficult, and then dividend investing for high dividend stocks, there's just for my risk profile, there's a lot of risk, but other people like it. But there's so many new alternatives that are unbelievably powerful, where you still benefit from broad-based investing, and still get the benefit of potential monthly income that could replace dividends in your portfolio.
Sure. Let me ask you this. Let's take out covered calls. Why not just go with the good old Warren Buffett approach of the S&P? And I mean, at the end of the day, if you do that consistently over years, you will retire, as they say, maybe 1.2 million.
Yeah. Yeah, I think there's a strong case to be made for that. And that's something that in the long term makes a ton of sense. In the immediate term, though, if there are requirements that you have for income, you can still get a lot or most or all of the benefit of that Warren Buffett idea. But when you add sort of these other tangential value drivers on top, you get a little bit of best of both worlds. And so that's where the balance component comes in. And the other thing, too, that I don't really talk much about that was really, it wound up being really great for the family, was if I had to sell shares in October 22, not only would I not have had the additive income, but all of the capital growth from over that period, I would have lost out on. And so this enables you to keep your money on the table invested in that Warren Buffett strategy to do so. So the answer is I think there's a case to be made to take a balanced approach because it allows you actually to stay in the SPY potentially more because you can supplement some of the income needs by the new strategies like this.
Okay, you have the SPY approach, and I think even so, and I may be wrong. Someone would have to double check me here. But when Warren Buffett was quoting, right, just go with the S&P, I don't think there were all the investment vehicles that were available. I mean, today out then. And I think perhaps if there's a moment where he can shine and come to light again with that, would he say the same thing?
And I think, it's one of those things where the core of what Warren Buffett is saying is still intact. And that's the beauty of it because you still get the benefit of that. What is it? 83% of funds actually don't beat the S&P. You still get that benefit. And you get the potential for something more. And it's that combination, I think, that makes it really powerful to, it's not an either or. It's actually, we agree with Warren Buffett 100%. And let's see what we can do to help from a structural perspective, add more value on top of that idea.
So I want to back out entirely and ask you a much broader question because, even as you were opening up and you were sharing that financial education is so important, I want to toss this question to you. What do you think the biggest, or I'll say most common mistake investors are still making today, despite all the information that is out there and available to us all?
I think there's a few. One of the key ones is just not starting early enough. So one of the things thinking about early on in the education process, right? Kindergarten, elementary school, I really passionately think that financial education should be instilled early on in education at that point, to the point where like when we get this foundation going, I would love to take a targeted approach and provide, a portfolio. Say, here's $600 per kid that they can start investing at an early age with their parents' help. And then as far as pulling the resources out, wait till you're 18. But they'll see for themselves and be able to learn the benefits and the power of investing and all the lessons that can come along with that. But the actual experience to do so and starting earlier, time is your best asset when it comes to investing. And so making sure that there's time in the market, I think is the number one thing to sort of spread, to get people interested, to get people educated so that we can alleviate the fear around it and to get people to participate in it because it does have really fundamental effects on the quality of people's lives. And that's, I think, a core thing that we want to make available is that kind of education at a very, very early age.
I'll say the one thing that I've heard like through and through across the board when it comes to investing in new investors is this element of fear. And I want to ask you, and even from your degree, right, in engineering, and you didn't start off in the financial space, but you're here now. How do you overcome fear? Like you overcame it to even start TappAlpha in some sense. I mean, you had plenty of, I'll say, quote unquote, excuses to throw around and say, well, I might not be the smooth move now. We got the baby on the way. Might not be the best move to jump into the stock market and go all in on, TSPY, but you did all these things. How'd you overcome fear and how would you recommend investors come around to overcoming fear?
Forward motion. One of the things I actually fear now more than anything is complacency and staying where I am. And the thing that I learned in starting my first company and now the second is if you don't take a step forward, you'll never learn. And I used to have a fixed mindset where I thought, especially when I was young and trying to be an executive or whatever, and you thought you had to have a persona. But then I realized the more authentic I could be, the more effective I was, just because I didn't have to spend energy being somebody I wasn't. And early on, I was scared to do the wrong thing. But it took me so much time to figure out what the right thing was that I never made the progress that I needed to make in order to keep up with the market. And so once I let go of that to say, it's okay, it's not win or lose anymore, it's win or learn. And when you learn, all of a sudden you snap into this growth mindset. And the growth mindset basically says, like, you're going to experiment stuff, you're going to approach this as somebody who's curious, but you're not going to take it personally when you don't choose the right thing. But the important thing is that you chose something. and that you're going to learn and you're going to get input from that something you chose. And that's the thing that helps you sort of make the decisions you make to move forward. And it's, I'm sort of known around the office as someone with terrible analogies. So my bad analogy of the day is like, if you're flying an airplane, you don't just set it on one path and then expect never to make an adjustment on the flight and you're going to land at your airport. Depending on the wind, depending on the temperatures, depending on all these variables that you have no control over, you have to adjust what you're doing. And by doing so, that's how you can actually get to the destination you're shooting for. It's the same thing in the markets. It's the same thing when starting a business. It's the same thing when taking any risk. And the other thing that's really important with markets is, you have time. And if you're a long-term buy and hold investor, like those daily bumps, they don't hurt because over time it's going to smooth itself out and you'll get the good days and the bad days. The trick is you just got to have your resources in the game in order to participate in the markets for the long term.
Sure, I love that. It's not a bad analogy, by the way. It's actually a phenomenal analogy. So, to your credit,
all right.
Bring
oh
that
no,
back
I'm going to lose my reputation of bad analogies.
I'll toss this question to you because there is an element then of fear that builds on investors. And I'm guilty of this one myself. When it comes to covered call ETFs, you are looking at NAV erosion. And again, you're trying to get the total return and figure this whole deal out. But investing into a covered call ETF does add a measure of fear for the ETF investor or dividend investors or risk adverse investors. So how would you explain the biggest benefit to actually investing in a covered call ETF like TSPY or others when we're looking at NAV erosion and a lot of us see that line just going down right over time? What's really going on?
So what's going on with NAV erosion is people's capital, their core capital that they put in the fund is being handed right back to them in dividends. So there's no real earning for that component that occurs. And so that's what you've got to watch out for, because essentially you're paying someone else just to write you a check with your own money. So it's really important to find, if that's not what you want to do, some income investors like that because they don't have to think about it. They just get income in their account every month. And for them, that makes sense. But for long-term investors that really care about capital growth, that's something to really watch out for, where if the yields are too high, you start to scoop out your core generating asset, which is your core capital that you had. And so finding a balanced fund, I think, is really important. And the other thing too, covered calls are actually really interesting. People ask me about, well, what's the downside? Like, what's the doomsday scenario? I'm like, well, the doomsday scenario is the same for the SPY. The market gets cut like in '08 by 40%. You're going to deal with that same kind of loss in the core structure. But if you're a long-term buy and hold investor, you're going to deal with that anyway. So that's a wash. But then the added risk is simply like you can get capped out. So depending on the covered call position, if there's a big run up in like a raging bull market, you don't lose money, you just don't make as much. And a lot of investors are like, oh, well, that sounds way better because I'm more scared to lose money than I am the opportunity cost of not making as much. And so for low risk investors, covered call strategies from a logical perspective provide more comfort because you don't necessarily lose, you don't have any additional risk to lose based on the underlying equity. You just kind of potentially lose some upside. And so dailies are really interesting because you can minimize the caps and you can adjust daily to sort of keep it in a place where you don't necessarily have to get capped too much. You don't lose too much of the upside opportunity cost on the underlying capital.
I want to go and zoom out again with you and talk macros because it seems like this type of strategy, especially when it comes to just investing in the S&P, doesn't really require you to look at the market every day, to be your head in stock news and macros. Now, I'm a huge fan of saying macros matter, and I like economics and just understanding what's going on. But in the case of TSPY, in the case of these ETFs, is it a necessity that we even pay attention to macros? Do you pay attention to them?
I pay attention to them every day, and that's some of the value that's added, but the investor doesn't have to because the fund is going to watch out on behalf of the investor. And one of the main ways that macros actually impact it, it's interesting. There's a benefit because option premiums are tied to volatility and macroeconomic announcements, even some of the big earnings for like NVIDIA and some of the big companies within the S&P 500, they have impacts on volatility. And if you position it right, the increase in volatility actually increases the premiums for strategies like this, which the fund will go out into the market and harvest on behalf of the investor. And there's two ways to sort of manage that. One, you can keep your risk. You cannot adjust where you would take your current strikes, or based on the macros, you can use that extra premium to extend the safety buffer that you have in order to still get that capital growth, get some of the harvested premiums, and benefit the investor that way. So all of that is done internally by, in our case, fintechs, in other cases, the portfolio managers, to add that value on behalf of the investor, so the investor doesn't have to worry about it. And they can just understand, like, the fund is going to take the same risk exposure as a SPY, but there's these opportunities on top. And all of that is something you don't have to stay up at night for. Over time, this is a long-term buy and hold product. It's one of those things that you'll wake up 5 years from now and you'll sort of see where the fund performance is. And hopefully it's going to be in a great place based on what the S&P does over that period of time.
It's safe to say over time, S&P will go up. I think. I don't know for sure. I want to.
Yeah, no one's got a crystal ball, but if you look at history, right? But past performance doesn't guarantee future results. But yeah, this is the calculus we do as investors, and nobody can predict the future. But there's a comfortable place that a lot of investors can be, especially if you have time on your side.
So this year, I mean, coming up and likely here in September, we might get interest rate cuts. Maybe, maybe not. Who knows with Jay Powell? But moving forward, even into the future, we have elections. We have all the economic data that's pouring out in between. So, okay, we don't have to necessarily look into macros. When do we invest? How often should we be investing into a fund like this? Because you just kind of shared that volatility should actually be our friend, not our enemy. So should we kind of pour money in when the market goes down? Should we just dollar cost average as we typically are doing, or what's the play?
Timing the market is very hard. And I don't recommend doing it because in a lot of cases, we're going to guess wrong. We're humans. We don't have a crystal ball. And so the book would say dollar cost averaging, just being consistent and disciplined about investing on a regular period with resources that you have, is a great way over time to continue to build equity in these sorts of things. There are dips and buying opportunities, but my whole philosophy has always been time in the market versus timing the market. So just getting the chips on the table when my chips are available to put in, and letting time and the strategy take care of the rest. That has been a phenomenal way for our family. And again, we don't have a crystal ball, but that's what I've been recommending to the people that I care most about.
What I love most, and I've heard this quite a few times now from you, is you share your family. And so it's not just, another founder and CEO that we have on with us. For all the investors who are watching, that says, I have all these funds, but I'm actually doing something else. It's like, and we've had quite a few of them on. So I appreciate you even sharing, like, this is what I'm doing for my family. I'm all in. This is my strategy. This is why I started this company. And I want to point that out for everybody because I think it's key. I want to toss this question over to you too and see how you answer it. We just watched NVIDIA not too long ago go to the moon. We're watching growth stocks. I mean, Google right now looks like a pretty great opportunity. Again, can't predict the future, but where it's falling to, plummeting, maybe in 10 years from now, might be in a better position. I'm curious to know from your standpoint, if you're really looking for growth and we're really talking about total return, why not go into these growth stocks and be all in on growth as opposed to the ETF route or dividend route or covered call route?
Again, it's the risk profile. So from my perspective, this is me speaking personally, the concentration in one company and the risks that happens from one set of executives making decisions or one bet that they make, and having my entire reality be tied to that and my family's reality, is a very difficult equation for me to sort of get my mind around. Versus, that's what I love about index investing. We get to participate in every single one of those companies that you just mentioned in their upside, but we're diversified in a way across all of them. And we have other sort of market sectors that can sort of help pick up the slack when tech takes a hit or NVIDIA misses an earnings that, they took a hit because they didn't exceed soft expectations in the last, they crushed it, but it wasn't enough for the street. But we were fine because we were part of the S&P. We got hit, but over time it's come back already. And so it really is about risk. And if you can diversify, S&P 500 has been a great diversification tool for a lot of investors. And that's really where we wanted to start the flagship for what we're doing, because the fundamentals of whatever index you care about most has to be part of the thing that you invest in. And so for us, it's about diversification and not putting too many eggs in one basket.
Let's go back to the Katara track record. And I'm curious to know perhaps one of your biggest investing mistakes or lessons learned over the years.
The biggest mistake has been getting greedy. There's, it's interesting when you watch these strategies during the day, the market may give you something and you see it, and it's really baked, because if you get out of the rules for what you set for yourself and you hop the rail, um, you end up getting bit by it. And so one of the things I did when I was designing the strategy, on some days when the market would go down, I take a position early, and then in an hour, I would have basically captured 100%, 97% of that growth. So I'd close out the position, and then I'd chase closer to the money and try again. And sometimes there's these bounces that happen that punish you for doing that. And so what I learned, and actually was really, again, you know, live and learn versus like lose. I learned that being disciplined about the strategy and having your goal, and when you hit your goal, be happy with it and shut it down. That has been served us really well to make sure that we can stay within the goals of what we have as a fund, to provide the value that we know we can provide to investors over the long term. And don't get distracted by shiny things, because the market's going to show you a lot every day, especially with volatility like we're going to see and like we have seen. So just stay focused, stay disciplined, and stick to the plan. Don't get greedy, and everything will work out for the best.
Any tips or tricks on how to stick to a plan, how not to get greedy?
I think writing it down. So I literally have a piece of paper right in front of me that has guidelines where, on a tier one day, so tomorrow, for example, CPI is coming out. So I've got rules for a tier one day. When there's a tier one macro announcement, this is what you do. And in some cases, if the vol is too high, like, we won't trade, or we'll trade way out, because if there's a skyrocket, I want to make sure I'm capturing the skyrocket of the capital growth. And so I write it down, I stick it right in front of me. And when these things happen on behalf of everyone that's participating in the fund, I'm obligated to stick to these rules to make sure I can get the value that I've promised to aim for investors that are also participating in the fund. And it really helps just to write it down, because it's too easy to get distracted otherwise. And it helps you sort of stay within the rails. But design your rails. You got to experiment a little bit, but once you get it and you have proof based on the performance that you're comfortable with, you just got to stick to it.
We'll call it shiny object syndrome, when someone's chasing continuously chasing these shiny objects. One of the shiny objects, especially in the dividend investing space, is yield, dividend yield.
Yes.
Is that dividend yield 9%? Is it, can we get, 15%? Some absurd number with some of the Tesla fund that's out there at, an absurd, like 50 something percent. I want to talk to you about this shiny object. What is a good yield range that we should all aim for when we're looking at whether it's ETFs or dividend stocks? How do we know if it's actually safe, if it's reliable, and if we can invest into it and sleep well at night?
The best way to assess that is to crack the hood and look under. Everybody's posting the yield number. Nobody's sharing one level down. And so capital growth plus yield equals total returns. Looking at the history of those three variables is really the best way to assess what's the right fit for you. And so a lot of the super high yield funds, and it depends on the market too, right? If the market's bearish and they're still getting a lot of yields, that's something to keep in mind too, but it depends on the market condition. But look at those three things and see, like, if the market's going up and I'm getting a huge yield, but my capital growth, I'm losing money, is that the right fit for me? Because my total return actually isn't even going to keep up with the underlying security. Those are the three magic things to do research on to see if it's a fit. Yield, I hear it all the time. And that's one of the things I'm like, it makes sense for some investors, but for me, I've got a long timeline, knock on wood, where capital growth is still very important to us. So I don't want to trade that capital growth for some large yield number that I'm going to have to pay taxes on now, when the capital growth is going to be long term and I don't need it today. So those are the three things that I would really look closely at when deciding if a fund is the right fit for you.
Sai, you have effectively, by taking on a role now of founder and CEO at TappAlpha, almost entered into the dark side of like the financial world of Wall Street. And you were once one of us average Joes just as an engineer. So before you go deep into that path and hopefully you keep your light, I want to ask you from your experience already, is Wall Street trustworthy and how do we know who to trust on Wall Street? Because even this interview, right? You're on with us. We have, TSPY and all the other funds that are out there. How do we know who we're actually able to trust? Because a lot of people share we can't trust Wall Street at all.
Transparency. And it's one of the things that I was most concerned about and also most excited about in coming to finance from a different world is I came in with fresh eyes. And so I'm seeing all of these things now in the market and how ideas are communicated that I'm like, that's interesting that that's actually not front and center versus being tucked away. So I think the best thing is transparency and working with the funds and the people in the game that are the ones that are being most straightforward. Like you're not going to get something for nothing. There is always a trade-off to be had, and it's not anyone else's job to decide that except for the investor. So the investor has to have the information that they need to make the decisions that are going to be best for them. And so that's one of our core values as a business is transparency is the most important thing to build trust in the market. And so one example of that was when we're doing these trades daily, the banks sort of they do their information sharing after market close. But if you're an investor, like you probably want to see what position we have right now. So we actually spent resources to build an automation that as soon as we make the trade, we automate and push the information of what trade we make, what position we took out on the website so everyone can see it. So from a transparency perspective, you know exactly the level of risk we're taking. You know exactly the positions that we're taking because that's the only real anecdote or antidote to the trust issue is just transparency, openness, authenticity so that you can actually make your own decisions as an investor.
Love that. Transparency is certainly key. Looking ahead into the future, and we'll transparently say, you don't know, I don't know, but I want to ask you a CNBC style question here on the horizon for us all. How do you see the market, rolling out in the next, say, 6 months, 12 months out from here?
It's going to be so interesting. So each of these macro events that happens, this is a huge policy shift. When we were going up, and from an interest rate perspective, we plateaued, and now we're talking about going down. And the question is how much? This is a really interesting tipping point for the market. That's going to increase volatility, I think. That's going to have huge impacts, especially for strategies like this, where volatility is a good thing. Income that comes for income investors, that's going to start to go down if your income investment is based on the current rates. And I really think it's a great moment for releasing strategies like this. And it's going to be, I think, a really exciting time to sort of watch now monetary policy shift and see the economy sort of level out a bit. But people, there's been a couple dips that happened over the last 2 weeks where there were big losses, the mini Black Monday, and then it came back by Friday. Those things are the Fed has really it's a pretty broad brush tool with interest rates, but it's a tool nonetheless where there's a lot of dollars, 5.25 basis points to come down, or 5.25 percentage points to come down. The Fed has a lot of tools at their fingertips in order to sort of keep things regulated the right way. But again, to trust, there's a lot of folks on the street that don't trust the Fed to do the right thing at the right time. I've been watching over the last couple of years, and the economy is in a pretty solid place right now. The election is going to be interesting to see what happens one way or another. It's going to have some ripples. But if you're a long-term buy and hold investor, time in the market, find places where that volatility can help, but it's not going to matter as long as you're in it for an appropriate time horizon. So we're going to stay in. We're going to continue to see what happens with the ups and downs, and we're super excited to sort of get these new ideas and new products to market that can hopefully benefit everybody, not just the select few.
I got one last question for you. It is my favorite question to ask every master of the market who joins me here in the chats. If I were to give you $10,000 right now to invest into one investment, one investment play with the 10K. I kind of have a feeling I know where you're going to go with it, but I'm going to toss it over to you. Where would it go, and what's your why?
I would find the the risk profile that is the match for you. And so you have probably a certain comfort level. And then you also probably have uh, your favorite underlying securities or indices. And so you've sort of answered a big part of the question already of like, these are the things that I am comfortable with, and this is what I like. I love the NASDAQ 100, for example. I love the Russell right now. And then find the right tool that can take that underlying benefit, but potentially add a little something on top so that you can really maximize the potential of what you have in that $10,000 to fit your needs and fit your beliefs, because that's the best way to sort of hit the goals for yourself. And that's going to be different for everybody. For us, SPY was it. So we're launching with this fund. We'll probably extend it to other things, TDAC for the Qs and TRUS. But for the moment, for our family, the answer to that question is yeah, let's go with Warren Buffett. Let's add some income on top, and let's try and get the maximum of the potential in the investments that we have. And you start to see that over time. You look back 10 years later, it's going to be a new world. But if you don't put your chips on the table, we'll never get a chance to sort of see what they could have become.
Investors, we have on with us again the CEO, the founder of TappAlpha, Sai Katara. Sai, I want to say thank you for joining us on Masters of the Markets, the insights that you have shared with us. Investors, I want to encourage you to go explore TappAlpha. They're a new name on the block, but one worth exploring. And of course, if you're looking for that reliability, that safety, and most importantly, that income, it might as well be found right there in TSPY. So again, thank you so much for joining us. And investors, until next time, we'll see you in the next one.